Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Veda Tchir of Economist Securities writing, for the first time in weeks, I'm optimistic about the outlook for the economy and for markets, but it is tempered slightly by all the measures it took to get here. Pete joins us now for more. Pete, good morning.
Good morning.
Where's the encouragement come from?
Well, first I wrote that like at 9 a.m. on Sunday, so I'm probably not quite as encouraged as I was. For me, what I would really like to see is a true pivot towards domestic growth, right? Let's get the CHIPS Act money out there. You know, last Thursday at the cabinet meeting, a couple of the people talked about shipbuilding. I think we have to spend some money, do some things domestic growth, long-term contracts either with shipbuilders, something to, that we can really get our hands around and grow, build up manufacturing without necessarily having to fight with the rest of the world.
Do you think it's likely we'll see that?
I'm increasingly dubious. I did not like, all the mixed messaging we got on tariffs over the weekend, right? From Friday night, no exemptions to more exemptions. And I think I'm a little bit worried about bond yields as a whole. Partly, I do think foreigners should be selling. I think you can get better yield in your own country. There's all this talk about, potentially fees on foreign holdings, Mar-a-Lago Accord. But beyond that, if you just take away, I think we missed three things last week. The budget for the military, Trump wants to do $1 trillion instead of $800 billion. That's going to add to the budget. We just had very large debt ceiling raises. That gives them the opportunity. And finally, DOGE at the Thursday morning cabinet meeting basically said they're targeting $150 billion for this year instead of $1 trillion. And places like the Wall Street Journal things are reporting that they can't even come up with $150 billion. So we are not on the right track on the deficit, which I think was everyone's big hope. So I think bond yields lead us lower across the board right now until we do something domestic to help growth.
Bond yields lead us lower. Can you elaborate on that? By the way, coming out and saying that you're optimistic and then this litany of negatives really is just,
He did say he wrote it at 9 o'clock yesterday morning.
That's true, which gives you a sense of just how quickly things are. So what do you think?
And I was very, 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 so I was thinking, we were like heading towards 20% down from here. It feels like it might be more controlled. I will watch very closely today. When we went through the GFC and even the European debt crisis, one thing that always struck me as key when we moved to a new leg of the problem was you'd get the announcement you were hoping for, so in this case tariff exemptions, and if you don't last a full day on the rally, it tends to mean the market's now looking through that and saying, okay, yeah, these exemptions, whatever, let's look what we actually have on the table, and it's a lot of problems out there. And the other part that makes me a little bit nervous that I think we'll see is if we stick to tariff deals, I think tariff deals are easy. I think we're going to have to go after trade deals. And to me, trade deals will require import quotas, something like that on behalf of these other countries, and possibly restrictions on what they can do with China. I don't think that's going to be that easy for them to digest. So I think we'll learn a lot more in this week about deals. Tariff deals, I'm comfortable with. If it goes down trade deals, I think we take another leg lower.
I've seen so many notes where people talk about how exhausted they are and how stressful this period is. And I was thinking about why. And there's this flood of information, and it's hard to understand what structure to even put them in. What have we learned versus just tidbits of information that are coming in at you in rapid fire? Have we learned anything from the turmoil of the past week? Are we past peak uncertainty and heading into something that we can more concretely hold?
So the biggest thing for me that I can't quite figure out, and I think is really critical, is did China get sucked into being more aggressive on tariffs? How we play this out? Did we make it look like it was the U.S. versus everyone? China was more aggressive and now regrets it? Or did we learn that China really doesn't care, that China spent 4 years preparing for this and is really ready for the fight? I lean towards the latter. I will give the people who talk about, art of the deal and 4D chess, that it could be the former. And if it's the former, that's great, because China will have to back off. If it was the latter, we're not really prepared for this at all.
I'm pleased you went there. Is there any sign that China's coming to the table? Do you see anything at all?
No, I think, we have to go back, and we're about 15% of China's exports. And, I think they exempted 25%, whether it lasts or not. But I think that's also looking at it on the raw dollar value. I think from a profit margin, we exempted probably China's most profitable things that they export to us. I don't see them come to the table. I see the rest of the world talking to them. We've been and which is very dangerous. And again, if you're in that part of the world, you probably have to play nice with China. Their military is there, their navy is growing. It's unclear what direction Trump wants to go on some of that. And the rest of the world, I think, is very tired. The uncertainty doesn't do well. And everyone knows it's going to take years to rebuild manufacturing, which is why I go back to I'd be much more optimistic if we started doing things domestic. Maybe we buy $10 billion of Navy ships, but they have to be built in a U.S. shipyard. And that's going to be 10 years of delivery, but it can start that process.
We've talked a lot about the pressure that was put on Europe, and it's pushed Europe to do things that is good for Europe. And I just wonder if this pushes China to do things that is good for China, in line with what the president would actually like to see from China, which is a rebalance of the economy towards domestic consumption. Are you hopeful?
No, I just don't think Chinese consume the way we do. Quite frankly, no one consumes the way the U.S. does, right? We consume a lot, and that's another concern about the economy, right? We're seeing some delinquencies tick up with all this uncertainty. I think China is going to try and do what they do, trade with the rest of the world, trade with us, and we're going to figure out where they have the opportunities. Again, they've spent the last 10 years building up 90% of rare earths and critical minerals are refined in China. We can get them anywhere. I think that's not the hard part, whether it's cost justified to get it out of anywhere. It's the refining, and again, that's going to take years. So China's putting all this pressure on us. And again, this was ridiculous 5 years ago, when we talked about this at Academy Securities, the number of things that are really critical to military equipment that we were getting from China when we were having all this friction with China was insane. So bringing those back makes sense, but we've done it in such a way that I think we've left ourselves vulnerable in the meantime.
So it seems like we haven't really gotten much clarity when it comes to understanding the off-ramp between U.S. and China negotiations. We do have a sense, though, of what that off-ramp looks like for President Trump to cater to a market, specifically the Treasury market. And I want to go back to something that you said, which is that you think that the bond market is going to lead the rest of the markets lower from here. Have we learned something about where that Trump put is in terms of what kind of levels of bond yields get him nervous?
A little bit, but I think it was very easy with all the noise last week to talk about this as being foreign selling, this basis trade unwinding, right? So, the Fed said they would, they would protect the bond market, which I think they will. They'll buy some here or there. I don't think we're going QE, but I think it was very easy to think of this as a temporary thing. If the conversation starts turning, as I think it might, that our deficit isn't going away, Doge isn't being as successful as we wanted, we are not being spendthrift, I think that starts putting even domestic pressure on yields and people saying, well, maybe even with inflation coming down, we're not at the right level. So that, to me, would be a bigger problem, right? And it'd be hard then. So what can he do? I'm not sure at that point.
Okay, so if you get to like 475, if we get to 5?
I think they're
I'm
begging.
trying to come up with structures.
I don't know. I think they're begging the Fed to support. And again, a lot of this happened overnight last time. If it starts happening more and more during the day, that's where I think the fear comes out. But I don't know what he can do other than go flip-flopping on tariffs. Yeah. And it feels like they're kind of tired of flip-flopping on tariffs. And the other part is with this whole deficit, right? We were at one time, and it was always confusing how much of that was going to be the case, but tariffs are going to help reduce our deficit. Well, if that income's not really coming in, where are they going to get other income? And I think they're going to target foreign holders of treasuries. Again, there's talk about delisting some of the Chinese ADRs. I don't see what that really does at this point, but that probably triggers yet another response from China. And I just keep thinking that we expect China to make these simplified moves. And we've talked about this before. Xi has learned something. Trump 1.0, Xi was the first one to Mar-a-Lago. Every time Trump said tariffs, they raised their hand, trade delegation. They have played this very differently. So just like Trump administration has had 4 years to plan this, China has had 4 years to plan this, and it's beginning to look like China spent a lot more time and money planning this than the U.S. did.
It doesn't look like a negotiation right now. In fact, Lisa and I were talking about this yesterday. It looks like the U.S. is negotiating potentially with itself at the moment. You're not hearing much back from China. I wanted to finish on one final point with you, because you've been very consistent about this. As we work our way through earnings season, you've really, really raised the flag about the damage being done to the American brand. Not about the attractiveness of U.S. assets, but the attractiveness of U.S. goods US services. How much damage has actually been done?
I think we are going to see some of that. And this first wave is going to be a little bit difficult to tell whether it's just because of global economic weakness that foreign sales sell down, or you're going to have to start looking, is there an indication that, say, Cadbury, for example, starts doing better than some of our brands overseas? And that, I think, will be the real key. Try and figure out pairs where, okay, here's a European or other brand, and are their sales declining or changing relative to the U.S. brands? And I think that would be a big shock to the system, because I do think people believe, and you can see it in some of the price action today, that there's just this huge demand for our brands globally, and it's only being affected by tariffs. I think we've diminished that as part of this overall trading strategy, and that's going to be harmful. And I think we may even see some companies talk about it. I think it's too early this quarter, but as this goes on, I think that becomes an issue for the rest of the year.
Interesting. One to watch. Pete, it's good to see you. Thanks for dropping by. Peter Tchir there of Academy Securities. If you're looking for stability in the bond market, you've got it at the moment. We're down across the board here, across the curve. We're down 6 or 7 basis points at the front end. On a 10-year maturity, the yield is down 6 to, let's call it 4.43. Let's turn to the economy. US consumer sentiment falling to its second weakest reading on record, while inflation expectations soar to multi-decade highs. Nela Richardson of ADP writing, inflation has made consumers cautious, but rising incomes can help cushion any tariff-driven price increases if they come. Nela joins us now for more. Nela, good morning.
Good morning.
Let's just focus on the data and get away from the politics. Are incomes still rising?
You know, we're seeing that when we look at payroll at ADP, they're certainly rising, not as fast as they were 2 years ago, but at a healthy clip, faster than before the pandemic. There's also a different source of income that's really important to think about, which is the housing market. We get housing starts later this week. Home equity for homeowners is up almost 9% from a year ago. So no, it's not the highest home equity we've seen on record, but it's close. It's like the third highest. And so that's another level of cushion. I don't mean to be too Pollyanna on a Monday, but I also want to give a real data reality check to all the uncertainty that's out there in the market.
I was just going to say, you're not complying with the narrative. I love it. I think it's great, and I think it's good to push back against it, because there's so much gloom and doom about companies who are frozen, who aren't going to be hiring. They're not going to be firing, but job mobility just isn't there. You're still seeing just some signs that consumers are maintaining resilience through other means, even with the stock market that maybe rallied last week, but certainly didn't feel like it, and even with the idea that it might be harder to get a raise.
You know, I don't discount the sentiment, because sentiment usually triggers certain behaviors, and you see downbeat sentiment with consumers, with home builders, with CEOs. Everywhere you go, there is a pessimism in the outlook. But then when you turn to the raw data, this week is super important. Why? This is the reference week. This is the week that the BLS will start counting the number of people who got paid for for their employment report. And this is the week that ADP will report in 2 weeks to talk about the labor market. And if you look at this week and you compare it to March, what you're seeing is that hiring is still solid. And if you look at one area of sentiment that is holding up, worker sentiment, we're actually going to produce a worker sentiment index tomorrow, publish it at adpresearch.com. What you'll see is that while consumers are downbeat, workers are highly engaged. They're plugged in. Maybe it's because they're cautious about their job loss, but they're showing up, they are engaged, and they are productive, and they're doing so because they want to make sure that they keep those jobs as they move into the rest of the year.
So quiet quitting has died, basically, is what you're saying, which is actually
we're seeing less
really welcome.
of it.
That's fantastic.
We're seeing less of it.
I'm curious. You say that hiring is remaining solid.
Mm-hmm.
Is it in specific industries that give you a sense of potentially whether this is a resilience factor or whether this is people getting old and needing to cater to them of getting factor?
Yeah, that's a great question, because we really do see a good news, bad news scenario there. We're seeing hiring across firm sizes. That's good news, especially if you look at small businesses who are price takers in the global input market. We're seeing solid hiring across the board, but not every industry. In fact, if you look at consumer-facing industries, they're somewhat discretionary, like leisure and hospitality. It's been weaker. If you look at retail, also weaker. So we're seeing hiring in, ironically, manufacturing. So we don't know if that's pull forward hiring to get ahead of some of these tariff and trade changes, or if this is a real rebound. And we're seeing it in B2B services, but not so much in consumer-facing industries. That is a sea change, and it's tied directly to consumers and how they're feeling about the economy.
You talked about the importance of expectations. Let's talk about how consumers are feeling about this economy. You mentioned on Friday, consumer sentiment, almost 3-year low. Inflation expectations, multi-decade highs. Unemployment expectations, the worst since 2009. Are you seeing anything in the hard data to validate consumer confidence that weak, that poor, that we saw on Friday?
On the labor market, no. Layoffs are at, a 2-year low. They continue to hover around those 2-year lows in the private sector. Different for the federal government, but in the private sector, we are not seeing that kind of upturn and upheaval and pause in hiring that is being projected or picked up in the sentiment. Now, things can change rapidly. I'm not saying that the outlook that we're seeing right now is going to be consistent 6 months from now, but if you're looking at the starting point and the baseline, you're seeing, and I think Chair Powell said this in his recent remarks, a labor market that is solid and continues to perform.
Still this massive spread, Lisa, between the soft and hard data. I keep going back to that headline from you, Mitch. To see unemployment expectations down at the worst levels we've seen since 2009 is pretty staggering.
It was funny. You were mentioning that in the past couple of weeks. Lori Calvasina put that out in a report saying that in all of the earnings calls, also corporate executives have been talking about how this reminds them of 2008. This reminds them of 2020. This reminds them before that of the 2000s. You see that in the AAII sentiment survey as well. So at a certain point, have we really reached a new paradigm shift, though, where suddenly the soft data has not been predictive of the hard data? Or are we going back to something more normal, where you would normally see a correlation there?
So the Federal Reserve's not blinking, and neither the Federal Reserve will be meeting in early May. That meeting concludes. We'll get that decision on May 7th. What do you make of how they've navigated things so far, and what would you expect to see in a few weeks' time?
I think the Fed has navigated the way Main Street has. They're waiting and watching. There hasn't been any big money moves that we can identify. And I think it's too early on the policy front to make any firm movements. And that's what you're seeing from the Fed. But it's also what you're seeing from small businesses and medium-sized businesses who can't change operations on a dime. Consumers can't change spending patterns on a dime. So what you're seeing is an economy that started from a solid baseline in wait-and-see mode, just like the Fed.
There was this discussion that we had, and it was off-air, about whether this Fed is going to be really just targeting dysfunction in the Treasury market or whether they actually were going to be looking at levels. We're not going to close the spreads until the spreads get too wide, and then we're going to close them akin to maybe what the ECB has been doing. I am curious about this theory that Neil Kashkari put out over the weekend, saying that we at the Fed have zero ability to affect that destination of 10-year yields as investors try to get some sort of price discovery here. Do you believe that, or do you think that there is a level at which they do step in?
Well, I think this comes to your sentiment momentum distinction. I mean, the Fed operates at the short end of the curve. That is their mandate. And so I think if you take the literal interpretation of the Fed's actions, yes, they're not responsible for the longer end of the curve. But we know that the Fed has a huge sentiment role in all of this in itself. And just by their forward guidance, they can change the way the bond market reacts. So yes and no, hard and soft. We're still back in that distinction.
So I guess to sum it all up, do you see the unemployment rate rising quickly enough to get the Fed engaged in terms of cutting rates or having some sort of stimulative effort in the near term, in the next 2 weeks, the next 3 weeks, before, or the next 2 months, right before the economy really can turn?
Not in the next month, no. We have not seen the transmission mechanism multiply to an effect that it hits the real economy in a way that you would see the kind of staggering job loss that would justify on its own a rate move by the Fed. The labor market is still holding up. 209,000 private sector jobs created, according to the federal government last month. That's not going to be a downbeat measure by anyone's estimation.
Nela, it's good to see you. As always, thanks for dropping by. Nela Richardson there of ADP. Around the table here in New York, Henrietta Treyz of Veda Partners. Henrietta, good to see you.
You too. Let's just get to this. Are we allowed exemptions or not? Do they exist?
I mean, under the IEEPA tariffs that went on that are already at 20%, there are no exclusions except in the case of, like, if you're giving a donation from a religious entity. The semiconductors are tariffed. The pharmaceuticals are tariffed. Everything coming in, $498 billion, is effectively tariffed. So it's just going to get worse from here.
We're familiar with all these different buckets. Speaking of getting worse, sectoral tariffs. What would they look like, and when will they be announced?
So I think that the 232 tariffs are the most pernicious kind that we can get. And in the 2025 environment, 30-day comment periods are pretty much all we should expect. We saw with the auto investigation back in 2019, was it, that they don't even necessarily release the investigation after it's confirmed. You know, they're just putting these tariffs on. So I think for pharma and for semiconductors, the worst case scenario is that sometime in this 30, 60, 90-day window, the tariffs go on, the comment period happens, and the tariffs are on before the summer.
What's the strategy here?
That's a great question. I mean, they want pharmaceutical manufacture back in the United States. We know that that takes 5 to 7 years to get the various approvals for even opening the facility, let alone having the workers come in and actually do the manufacturing on those kinds of products. I think that the semiconductor space is exactly the same. When I'm on calls with investors, they're talking about, thank goodness we had the investment from the last administration into semiconductors from the Chips and Sciences Act, a bipartisan bill that passed years ago, to keep, you know, providing any kind of support to the industry because it's going to get slammed from the tariffs.
I'm just asking because the complications here are pretty dramatic. Trying to keep track of which tariffs have gone on where is a bold task when you try to talk about what the actual effective tariff rate is, let alone how you plan for the future and what that could be with additional rounds of tariffs coming on. What are people telling you?
That's the stories that I hear the most are the anecdotal data points, as you were talking before about connecting the soft data to the hard data. The bankruptcies that they're expecting, the seizing up at the ports, the manufacturers halting hiring, halting production, keeping their products on ships, in cargo ships. There's a lot of reminiscing about COVID era when the ships were just idling in the port. We're going to have to all go back to like monitoring the Pacific Ocean and see what kind of fleets are out there. That's what folks are talking about now and anticipating seeing in the hard data in the next couple weeks.
Just got a message from a Bloomberg subscriber. This sounds very chaotic. The market seems to have priced peak chaos is behind us. What are we missing? What are we missing?
I don't think the stories have come out yet about how this is going to impact actual domestic manufacturers who rely on foreign imports. You were mentioning critical minerals before. How are you supposed to make, you know, your windshield wiper sensors if you don't have the magnets that go into it? So if you stockpiled enough in the last couple of months to get in around that, you have some certainty for a couple of weeks, but that it's not a sustainable situation. I think the hard data is going to come out next for the next couple of weeks and months, and these tariffs are not going to come off, especially if they're done during under 232. Those are the most pernicious. 301 is pernicious. I mean, these have real staying power for years.
And then we need some relief. Taxes. What's changing with the tax push at the moment?
Man, you know how I feel about this. The tax component, they're now, President Trump is talking about it as tax cuts and deregulation. You are not permitted to pass deregulation via reconciliation instructions, and Democrats will not be working with Republicans on a crypto bill or any other deregulatory legislation. So unless you like the emission standards components, which are going to get reduced in a, $75 a barrel oil situation, you're not going to see a deregulatory push anytime this year. And certainly not until you get certain agency officials seated in their positions in the first place. And then the tax bill, I think, is going to take until the end of July. And as you know, it includes $4 trillion in deficit increases and very little in the way of new stimulus. So I think there's a disconnect between the narrative and reality.
Given that, is there a loss of power that Trump is having or a loss of a clutch over the Republican House caucus?
I don't buy that argument. They passed the budget vote last week, and I think that was the biggest hurdle. The next step is, are you going to vote for tax increases on every single American, or are you going to vote for this bill? And that's a cut and dry. The whip is easy. All members are going to support that.
There is this theory that if things get chaotic enough and if some of these proposals are outrageous enough, there is going to be the ultimate check, which is going to come by congressional action against some of these tariffs or potentially a court action. Do you see any pathway to that, or are people just wishful thinking?
No, I see no path for that either. If you can get 6 or 7 Republicans to join on to a Senate bill, that is wildly insufficient. I think that President Trump needs these members through this budget vote that happened last week, and now through, let's call it Memorial Day or July to pass this tax bill, and then he doesn't need them at all. And no legislation is going to pass. There will be no reconciliation authority. There will be no more legislation, which is, by the way, the playbook from the first term where we got a tax bill initially and then spent the next 3 years doing tariffs. And that's what I expect here.
Just quickly, are we at the point where they're all quoting Treasury yields to each other down on Capitol Hill?
No.
We're not there yet.
I'm not sure we'll ever be there. I wouldn't expect that.
I hope we never get there, because if we get there, we've got major problems.
Well, on one level, I kind of hope that they do pay attention, because it does actually matter. Suddenly, if you have a 50 basis point increase in 10-year yields, that increases by billions of dollars the amount that the United States is paying. So I hope they do quote those Treasury yields. Congress members, if you are listening, please get a Bloomberg terminal. Take a look at that 10-year yield. Take a look at the 30-year yield.
There's the sales pitch. I'm right there with you.
And plan
you get that
accordingly.
Bloomberg terminal. Clearly, the president was looking very closely last weekend coming into the trading week.
Yeah, it got yippy. People got a little nervous, but he dealt with that in one statement, and that's what he said. The issue is, do we have a true sense of where that Trump put is? Do we have a sense of what level, what type of chaos could potentially end up dealing with some sort of response from this administration?
Henrietta, it's good to see you.
Thanks for having me.
Thanks for dropping by. Thank you. Henrietta Treyz there of Veda Partners. Goldman Sachs adding to banking optimism after posting a record revenue haul from its equity trading unit. The stock is up by 2%. To discuss, I'm pleased to say, is David Ellison of Hennessy Funds. David, welcome to the program, sir. Appreciate getting some time with you. We've heard from JP Morgan, from Morgan Stanley, from Goldman. How would you grade the quarter so far?
Well, the quarters were great. I think the industry is showing that they're have done a great job of dealing with credit and liquidity and capital, managing the buybacks. So I think it's like that's all in the past, unfortunately. But I do think the industry is in great shape to weather what's ahead. I think your conversation with Gerard Cassidy this morning sort of put it in focus. But I think the industry is in great shape. Doesn't mean the stocks are going to double or triple or go down 50%. But I think as an industry, they're ready for whatever happens in Washington, I think.
Let's talk about that. As a portfolio manager, just how defensive do these names trade in growth scares, and how has that changed over the last decade, say?
Well, I think since 2008, we've been worried about a credit cycle, worried about a rate cycle. We've had an inverted curve. So the financials have been, frankly, not the place to be for 10 or 12 years. And I think the color of my hair shows it. So I think the hope is that as we go forward here, there's going to be a little less pressure on them as they, in a sense, the tariffs are not attacking financial services products, they're attacking physical goods. And so I think people maybe are going to be more worried about the physical good traders and makers than they are about the financial guys. So we'll see. I mean, Wall Street finds a way to make money in all environments. People need to lend money to grow. The economy's not going to go to zero. And so I think, these companies could be the safe harbor that they haven't been for the last 10 or 12 years.
David, the narrative around banks has shifted. At the beginning of this year, it was the growth stock, given the fact that there was supposed to be a wave of deregulation as well as a boom in mergers and acquisitions and all sorts of deals. Now it's a defense stock where suddenly banks are buying back their own shares in pretty large quantities. We just heard about a $40 billion repurchase from Goldman Sachs. Which is it? Is it defense or offense?
Well, when you sort of have one guy deciding what the world trade environment's going to be and a bunch of other stuff, I think, you look for defensive names, and that means you look for good balance sheets, you look for capital, you look for liquidity, and you look for good managers. And I think the banks have that. And so, this weekend was pretty quiet on the Washington front, so the market's up. So I think the general move of the market, I think, is the market generally wants to go up, in my view, and it's being held back by sort of one guy making decisions about how the world's going to function. And that, I think, will calm down, and I think we'll be okay on the other side.
Another way of sort of approaching the same question is which banks are best positioned for the next phase of whatever is to come? Is it the ones who are going to benefit from volatility in markets, trading revenues, some of the potential other opportunities there, or is it going to be the lenders, the Bank of Americas, that are going to go out and actually be able to create credit at a higher rate based on where the Treasury yield is right now?
Well, I think one of the concerns I think that's coming up on the analysts that I've talked to and the companies that I talked to prior to earnings was that is this disruption going to really hurt small business and therefore hurt the lending of the traditional banks that we haven't heard from yet, but we will in the coming weeks. I think the big banks, they have the earnings, they have the, in a sense, network effect of having a lot of customers and a lot of data inputs about what's going on. But I think the overriding thing about this industry is that we need new products, we need innovation, and we need companies to do transformative acquisitions to kind of get them back on a growth path. They've lost so much share on the lending side to private equity and private debt and other sources of income that the loans just don't grow anymore. And so they need to do other things to get out of that box that they're in. And hopefully that will happen as we move forward with the new administration.
We've heard lots of people say the same thing, that we're expecting consolidation, particularly between the regionals and the smaller lenders, David. What are you anticipating for the year ahead on that front?
Well, it started off pretty good. I think that I don't think that's going to stop. I don't think whatever the administration is doing now is going to stop that. I think at the end of the day, the smaller banks know that they're losing share. They can't invest in technology. It's hard for them to compete with these new platforms that seem to be popping up every day. They're competing for deposits and loans. And so they need to get bigger. And that's, sort of the process that you see that in the marketplace. The bigger companies have the higher valuations, and the smaller companies are going to be left behind. So I think the market is telling you something, and hopefully the managers are hearing that and seeing it.
David, appreciate your time. Tricky moment for you all, I'm sure. David Ellison there of Hennessy Funds.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.